GM. Trade of the day. GM. So, let's look at this. Yesterday we had here it is. That was the manufacturing PMIs. So the news came out, initial dump down, nice rally up, took out the highs, got back below it. This would be where I'd been looking most at trades, using the open price right when the news dropped as the pivot. It tried to hold it, failed it, broke through it. You got a nice trend down, took out that low. Your cleanest trade would have been that part there as a short. It then rallied back up almost for a retest, didn't quite get the retest, and quite a nice failure to return and a rollover, which led to this continued downtrend. So we've had a nice strong downtrend right down into the lows. Now the market's starting to bottom out into a key support as well. Like this is a pretty solid interim support level, and any moves lower from here, I think the market can absorb them quite well. And so today we've got GDP data, which is very important. 12:30 UTC. It's the same time that inflation numbers tend to come out, and most of the data tends to drop around that 12:30 area. And what are we looking at here? Well, that's going to be over here at 12:30. There we go. And same thing. You want to allow the data to release and see where price is going to move. I would say if you see something similar to what you saw yesterday, right, where the news drops and you see a move down, move up, and all this kind of chop. That time, whenever the news dropped, it tried to push higher and wasn't able to, and it led to a down move. This could be the same, right? We are in a downtrend. You could see an attempt to move higher that fails, that allows it to have another leg down. I would expect that probably gets pretty heavily absorbed though, as I do see a lot of very strong interim support below us. Now, whether this is bearish or not, this could be a bearish setup, and this could just allow it to bounce up into a lower high and then break down. Like Bitcoin is obviously in a downtrend. But as you're looking on a day trade basis, I don't think we're going to see a massive nuke today. Could be wrong. Let's actually see. Have people been buying the dip or not? So far. We still have a spot premium, which is okay. We've open interest rising here a little bit as the market drops down. A little bit of an uptick there. Yeah, falling off. Open interest rising up here. Positions are opening. So longs are wrong currently, which is important to note, right? As the market is in a downtrend, open interest is spiking up. Remember, open interest means longs and shorts. But if it's in a downtrend, you assume the longs can be wrong first, or will continue to be wrong. But what you could see is quite normal, a squeeze up to take out some of the short positioning first, but then the original trend direction continues. That's one thing to watch for. Funding rates are still below neutral on BTC, and if I check out on Coinalyze, you can see ETH's funding rate is actually ticking slightly above neutral, but let me open interest weight it. No, we're still below neutral, that's fine. 0.0062 when you actually waited for OI. BTC, same thing, I think. New OI weighted. It's right at neutral, yeah. So there's definitely some dip buying going on here. I do think that there's potential, right? I don't think this low is going to hold. For sure, whether it's today or not, that's not going to be the low that holds for fucking going all the way to the moon. So you might see a move up, you might see a sweep down. If it then reclaims, that might be where you start to see a better bottom forming. I wouldn't call that safe. I mean, this is just so far, it's just a carbon copy of that, right? And it will probably come and attack that. Whether it goes lower and stays lower, I don't know. But I would say that doesn't yet give me confidence that an actual bottom is in. So around this data release, we're going to have a much clearer idea of what's going on. And same as always, for me, I go 5-minute chart, I wait for the data to release, and I always allow the first 15 minutes to happen. So the data come out here, allow the first 15 minutes to happen, see what the positioning is initially, and then see how the market moves. Using the data point where the moment the price at which data releases is a good pivot. If price can't get above it, it's going to go back below and you're probably going to see a trend. If price does get above and hold, you can see a trend higher. So there's room for it to trend up. We've got a very inefficient move down here. That's a gap that can easily be revisited. There's a retest level up here it can go to. There's plenty of reasons why it can push higher initially, even if it's just to clear out some shorts. And below us, we're right into a strong support. There's definitely should be strong interim support there. So I would say, as the market is kind of conditioned to be bearish after yesterday, I would not be wanting to carry any bias into this GDP release. Lastly, I'll talk about what does GDP actually mean for the market, because the market will re-rate based on this. Well, GDP comes out every quarter, and people want the Fed to cut rates. And if the Fed are going to cut rates, you need to see a weaker economy, but not a recessionary economy. So the expectation today is for 2%. That's positive. That's growth. Right? 2% growth. Last quarter in Q1, which came out in April, the forecast was 2.5% growth, and we saw 1.6% growth. That was a big, big miss. Now, that's a good sign for a cooling economy. What you don't want to see is for that to continue lower again, because then if you're getting below 1 or close to 1, it's starting to actually move towards recessionary territory, because the market will react nicely to a weak economy, but it won't react nicely. It won't, like a cooling down economy. It won't react well to a very weak economy where it's recession. Recessions are bad, but narrowly avoiding a recession, so slowing down, is good. If it slows down enough, the Fed will be very incentivized to cut rates. If we see this miss, if you see 1.6 again or 1.5 or even less, the Fed will probably cut rates this month, 31st of July. They'll probably start to panic if they really see a big cool down of GDP. And that's how you could see, if you don't see something catastrophic, if it's below 1, that's going to give real recession fears. The market won't like that. If it's above 1 but below 2, so it's below forecast but it's not majorly, that would probably tell the Fed, okay, right, we've tightened enough. If we don't start to loosen conditions and cut rates, we might see a recession, proper recession. And that would be probably the best scenario. It's hard to say exactly, but that would probably be the best scenario. And the Fed are more incentivized now than ever, because in October is the next GDP. So this is Q2 that we're looking at, right? So for April, May, June, the data comes out in July. For July, August, September, the data comes out in October. So the next GDP after this one comes out right before the election. And so if this has any signs of being scary, any signs of cooling or any signs that it might dip towards recession, the absolute no, can't happen, avoid at all costs, would be a negative GDP print in October right before the election. So I think they'll be even more incentivized to loosen up conditions here going towards the election. But we'll see how it goes. If it comes in higher, if GDP comes in higher than expected, and these are all just fake numbers, but we have to trade off the fake numbers. Everyone is playing with the same game, right? If it actually comes in above 2, markets will probably react negatively. And you never know. The S&P and NASDAQ have sold off quite aggressively yesterday. That could be some front running. Maybe there's a very good GDP print coming. I would guess that if there is front running going on with the NASDAQ and S&P of people who are in the know, that would tell me that either we see above 2 or a really low number. Because that's the two things make the market sell off. You're talking about this Goldilocks, right? That's what everyone's talking about here is with Goldilocks. Because Goldilocks is this perfect zone. Like the fucking fairy tale, it's the porridge, and the porridge has to be not too cold, not too hot. It has to be just right. Yeah? And so, not too hot, meaning you don't want the economy running too hot, because then the Fed will not cut rates. So too high, this is like GDP. Too high, they'll keep rates where they are, or maybe even raise rates. Too low, and you're getting beyond the point where the Fed can even help because you're getting towards a proper recession, which is bad for everyone. And then just right is somewhere in between. So just right in this sense for GDP means GDP. Terrible drawing. Too high, Fed have no incentive to cut, which is bad because the market's pricing in cuts. Just right, so the GDP drops, but it doesn't go into recession territory. Perfect, allows them the excuse to cut. Too low, all bets are off. Then they're going to have to cut in a panic if we go into recession. So, very interesting day. Big day. Keep an eye on that, GM.